The Fed signaled that 3 rate cuts are still likely, and that prompted an 80 basis point rally in the S&P and a corresponding decline in the VIX index. Does this present us with a suitable time to hedge? And we're also going to take a look at how options markets can give clues as to whether or where catalysts may be taking place, and we're going to use American Express as an example today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Open Mic, sponsored by OptionPlay. So, of course, we've got some big news today coming from the Fed, and that is that 3 rate cuts are still likely. Now, just as a refresher, of course, this is essentially what the dot plot suggested before today's announcement. But what's interesting is that if you took a look at what the markets in the rates were saying, they actually had just recently dipped below 3 forecast rate cuts for the year. So this basically reaffirmation that 3 cuts are still likely was viewed very positively. We got a quick 80 basis point rally in the S&P, and we also saw the VIX fall by over 70 bips down to below 14. So that got me thinking, is this an interesting time possibly to try to take advantage of hedging? Now, I already had some hedges on. I'm using SPX options to do it. We're going to talk about whether you're using SPX or some other index, or maybe an ETF option to hedge your portfolio, whether that might make some sense now that those options are considerably cheaper. But before we get to that, I wanted to talk a little bit about American Express earnings, which are going to be coming up in April. American Express is a holding of ours. And by my work and from the sources that I have, they're supposed to be reporting earnings on April 19th. The stock hit a fresh high today. It's up about 20% on the year and a huge amount actually since late 2023. And what's interesting is while I was on a call talking to somebody about the upcoming American Express earnings, and I should also point out that MasterCard and Visa are going to be reporting also in April, probably the week after the forecast that I had for American Express earnings. So let's talk about this a little bit. We'll probably come up with a way potentially to trade it as well. I'm going to share my screen with the OptionPlay app on it right now, and it's not going to be on the screen that I normally show when I'm first talking about it because I got this preloaded. Basically, I put a trade that goes out to May in it. Don't worry about that trade for the moment. Instead, what I would like you to focus your attention on here is this earnings date. So when you put a trade into this, and of course this is something you want to check whatever applications you might use, your broker platform or whatever, you obviously want to know whether there's a catalyst that could potentially move the stock. So if you are selling covered calls, which is a fine strategy, by the way, like that strategy, but it's not necessarily one that I advocate going into events like earnings. You obviously want to pay very close attention to when earnings take place. Now, you can always get concrete confirmation of something like that when you go to the investor relations website for the company, because they will actually tell you when they intend to announce. But what happens if you are trying to put on an options trade that may capture earnings, but they haven't already confirmed when they're going to announce? So many sources, including OptionPlay, including your own brokerage platform, including Bloomberg, which I also use, will tell you when they anticipate the estimated earnings date. And as we can see here, maybe if I highlight this, I'm not sure, but down here, April 19th is the forecast that OptionPlay has for American Express earnings. Okay, now as it happens, and we can switch over to another source on another screen here, and we can see that indeed that jives with what Bloomberg has. So here, this is just a forecasting mechanism, and here too, you can see April 19th. So I was on a conference call with several people, and I got 2 different answers than these two from the 2 people I was speaking to. One person said, Well, my system says that earnings are going to be on April 18th. And another person on the call said, well, my system is telling me that earnings are going to be on April 26th. Well, the 18th versus the 19th, not a big deal. Why? Because April 19th is a Friday. That's expiration. So that's all fine. If it is the 18th or the 19th, it's going to be that week. That's going to work out just fine. But what if it's actually the 26th? Well, if you bought options that expire on the 19th, hoping to capture the event, or if you sold them hoping to capture the event, and you get that wrong, that could be a problem. So I'm actually going to, look, I don't know these guys. I actually had never heard of them before today. So this is not a knock on this website, but I asked the person who said, oh, I see them as April 26th, where he got that information, because it struck me as odd that there was a full week's difference. And he said, I'm looking at something called earningswhisperers.com. And again, first time I ever heard of earningswhisperers.com was today. And I guess it's a free service. This is that page. I went to it, put in AXP, and sure enough, April 26th is the date that they have. So I thought, okay, well, which day is it? So there's a couple things that I kind of went through to try to guesstimate when this might actually be taking place. So the first thing I did was I said, okay, well, let's just take a look at the history of American Express earnings. And I wonder if I can put this into a dark mode or something so this is a little easier to read, because I realize that's getting blown out. Is there a dark mode for Excel? Probably. Let me just do, I'm going to do this. I'm going to actually put this all in bold. So what we're looking at here are all of the prior, this is the one that I'm forecasting, right? So April 19th of 2024. This is all the other Q1 earnings that American Express has reported going back for the prior 10 years. And you know what we can see is that it's usually the back half of the week, Wednesday, Thursday, Friday. It has been as early as the 16th, and the latest date that we have seen was the 24th. So, using that as a guideline, I am going to guess that the forecast that OptionPlay has, that Bloomberg has, and that other one that said the 18th, that all of those are probably correct. But what are the options markets telling us? Well, this is where if you're less familiar with options trading and less familiar with the concepts of implied volatility, which is how options traders typically think about the price of options, because that's the one input that basically is unknown when you're trying to calculate. You use an options model and you can put in things like the stock price, the expiration, whether it's a call or put, strike, dividends, interest rates, things like that. All of those are known. The expiration date is predefined. The strike is defined. Interest rates are, generally speaking, and I'm saying generally because there are circumstances where you have stocks that are hard to borrow, you have to do some funny rate stuff. But the rates that most traders use are just the risk-free rate. So we can actually take a look at how options are priced going out through time. And if this is a visualization that is unfamiliar to you, permit me to explain it. So all this chart is basically showing us is the price of options in terms of implied volatility, that one unknown that options traders use to price out an option. This near end over here, these are options that expire this coming Friday, that first dot. The next one here are the options that expire on the 28th, and then April 5th, and then here we have April 12th. Now notice what happens. As soon as we get to April 19th, it's sharply higher. And what that tells us is that options traders are anticipating more volatility beyond, inclusive in that date, than they did for the 12th. So clearly, if they're expecting more volatility on the 19th than they did on the 12th, that indicates that something is implied to happen that week. And normally when we see a curve like this, you get a high point around that event, and then it sort of slopes down and then goes back up, which is just sort of the normal price of options through time. But here we see something rather interesting because, yes, the 19th is considerably higher than the 12th. So there's a number of options traders who believe that there's an event, an important event happening after the 12th, but before the 19th. We go to the 26th, it is higher still. So clearly there are some options traders that think the event, maybe they're using earnings whispers, who knows what their source is, but there are some people who believe that the earnings result is going to happen on the week ending on the 26th instead. Now, why do I bring this up? If this had happened just once or twice, there could be these kinds of differences of opinion about when earnings are. The weird part is that this year, in particular, I've seen a lot more of this happening. Just a lot of names where there seems to be a significant difference of opinion about where earnings fall. And in almost every case where I see this, it is for companies that tend to report earnings late in the week. So Thursdays, Fridays, particularly, that type of a time frame. And what occurred to me was, well, what is so different about this year that would throw all the algorithms that are estimating when earnings are going to take place off in this way? Why would things be getting pushed into 1 week more frequently than they have in the past? And my hypothesis about this is that it has something to do with the fact that this is a leap year. If you can imagine that the typical algorithm says, okay, well, they reported on this date last year and a similar or very close date the year prior, all they do is they just sort of tack it on. And we have an extra day. And that means that if you have something that's kind of borderline, it could end up falling on one side or the other. And that's when you suddenly find yourself saying, okay, well, I need to do a more comprehensive analysis, like I showed on that barely legible spreadsheet that I had on my screen, this thing here, where you actually have to go back in time and do a little bit of deductive reasoning yourself to figure this one out. And then if you come to a conclusion, you have to think, okay, well, what then might I do about it? So in our case, one of the things I often like to do is to be short the options that capture N earnings when I am long options of a much longer maturity. So going back to American Express, let's see how we might frame a trade to take advantage of this. Okay, so like I said, this is a name we're in on the long side. I'm a little reluctant, though, to take long deltas, just purchase the stock after this really good run we've had. Now, just a reminder for people who didn't follow American Express's earnings in January, their earnings numbers weren't spectacular. I think actually it disappointed some estimates going into the print, but the stock traded up nevertheless. It actually rallied 7%. And what's interesting about that is that I always like to see on the long side, if you have decent price action on merely okay numbers, that indicates that there is some real strength and momentum in the stock. What you'll see in those circumstances is you get bad numbers in the stock either trade sideways, down slightly, or rallies. In this case, it rallied, I think, about 7%. And if you get good news, the thing just completely takes off. But now we've had this huge run, as this chart here illustrates. And in fact, maybe I'll just expand this out a little bit. We can get a look at how the stock has done over the course of the last 3 months. And you can see that this thing is up huge, basically. 20% year to date. Expand this out, and you can see what kind of returns we've seen. I mean, this stock was trading below $150 as recently as late October, and the thing is trading $220 now. Okay, so if you're inclined to make a bullish bet, and I still think the valuation is reasonable, they are more rate sensitive, arguably, than other card issuers. And speaking of other card issuers and earnings, Visa and MasterCard, all their earnings forecasts I have for them actually are the week following. So those are all going to fall into that April 26th time frame. So they're going to be reporting after American Express, most likely, very likely. Okay, so inclined to make a bullish bet on the stock. One thing that you could do, of course, is buy calls, especially given the fact that the stock has had this big run. Difficult one to chase. And try to capture some of the elevated earnings premium. Now, what's interesting is you could do this one of two ways. So one of the things you could do is say, okay, well, by the way, the next earnings, let's just go out. I'm going to use something that I know captures the next earnings because their reporting in July could also fall after the regular way July expiration date. So I could buy, for example, the 230 calls, not a cheap option, it's not a cheap stock. So $17 option, that's $1,700 per contract. So that's definitely something to think about. What option might I be inclined to sell? Well, if I knew for sure that Earnings Whispers had it right and that it was not going to report on the 18th or the 19th, the way OptionPlay, Bloomberg, and a number of other sources have it, well, I would absolutely want to just probably get into a straight calendar and say, okay, well, those options are overpriced. They've got this thing wrong. So I'm gonna sell that and just get into this calendar, figuring that there's probably not going to be that much of a move before then. I might even be inclined to get a little bit more creative and say, okay, you know what I'm going to do is I'm going to sit there and sell maybe an upside call and a downside put, because in the absence of new news, I can take advantage of the fact that I have elevated options premium going into a catalyst that doesn't exist, that isn't captured by these options. That's if you happen to believe that was true. I don't believe that's true. I actually think that the April 12th, oops, I'm on the wrong expiration here. I've got to advance that. I'm sorry. So just to be clear, folks, because I just realized I was clicking on the wrong thing. The forecasted earnings dates from different sources are the 18th, the 19th, and April 26th. So April 19th expiration. So these are the options I'd be looking to sell. Potentially 240 calls, 220 puts. I can collect more than $5 in premium against that. And if I did not think that that week actually captured earnings, I'm kind of getting a free ride here, right? Because these options premiums are elevated, looking for a catalyst that isn't happening. However, we just went through the calendar, and I think that OptionPlay and Bloomberg and these other sources that believe it's going to happen on the week ending the 19th are actually correct. Well, in that case, I don't get the free look. I don't get the opportunity to sell options that are artificially elevated, if that's true. So in that instance, I would actually go out one more week to the 26th to affect this trade. Now I know I'm selling options that are going to capture the event. But I'm also going to be collecting a little bit more premium. So the real thing that's going to move the stock is going to be the earnings event. And I'm going to try to capitalize on that now by grabbing the juiciest options I can on the board. I didn't get the free look. So I'm actually going to go out this way and say, all right, I'm more inclined to sell maybe the 240, 220s. I might even bounce that lower strike down. I'm going to probably say that I'd be more interested in selling something, a standard deviation away or something like that. So now I'm getting a decent amount of premium as an offset. Not quite $5, but I've given myself another $10 to the downside. And as we take a look at this trade, what we can see is that, I don't really start to, suffer until it goes through that strike. And even so, it's going to end up behaving a little bit better than the stock would, and I get a small standstill rate of return. I'm still going to get to capture some upside, even beyond the strike of the call that I sell. And, one of the things I also like about selling off a little bit more upside here is that, we've had such a strong run already. So just a couple quick takeaways from what I know is throwing a lot of things at you here, which is that when you trade options, pay close attention to when those catalysts are, but bear in mind that the sources for your information don't always have it right. And that's definitely the case here, because we've got 3 or 4 different sources, and they have, so I had one on 18th, 2 on the 19th, and 1 on the 26th. They're only going to report on one date, so those all can't be correct. So at least 2 are wrong. We know that. We've got 3 different dates, so at least 2 of those dates are wrong. And when you're framing your options trades, just try to make sure that you can take best advantage of that fact. And also, just bearing in mind that you can use the option, even if you don't trade options, you can use something like this term structure chart that I'm showing on my Bloomberg screen right now. Look at charts like this, and you can see whether there are, whether, where, etc. events are likely to take place. I mean, we've talked about it before. We have FedEx, they're going to be coming up with earnings, but you're going to see the same dynamic. You're going to see that there's elevated options premiums going into the print. They report on the 21st, by the way. So you can see, look how much higher these options premiums are than those that follow. And by the way, if you inspect this chart very carefully, you will notice down here, July 19th is visibly higher than the June options. So these are 24 vol, these are 26, and September is 26. So what we can deduce from this is that there is an event that takes place after June regular way expiration, but before July regular way expiration, that is being incorporated into the options prices. It stands to reason, given how far away that is, that is very likely going to be earnings. And we can actually take a look and say, okay, well, when are earnings, the ones that follow the 21st, and indeed it's June 25th. So regular way June expiration is the 21st. The 25th of June falls after that. That's why the June options are cheaper and the July options are more expensive. So you can do this for any stock. And I just thought it was rather interesting. Don't hear people talk about it as often, arguably, as they should, which is that you take all of this information from the different sources you have and then look to confirm it. And if you can go to something like the options market, just assume that market makers, that the folks at Susquehanna and Citadel and everywhere else are not complete buffoons. And chances are that they're also trying to do some work on this. And they're going to give you some clues as to when and where events take place. By the way, sometimes you're going to see these bumps in the vol surface that suggest that there's upcoming events, and you may not observe them. It might be something not like earnings, for example. Actually, I saw that quite recently. I think it was, and I may have even spoken about this one, it was Centene Health. So that's CNC. And I think I spoke about this before, but we can actually take a look here at the same chart and get this same kind of an idea. And we can see here that there's obviously something going on next week, right? So next week ends on the 28th. And we can see that there's a big expectation for something going on. And we can take a look at the earnings calendar and say, well, is it earnings? And the answer is no, because they reported earnings on February 6th, and their next one isn't estimated until late April. So what is that you were looking at? Well, Centene Health is a contractor. They provide basically the equivalent of managed care services to states for their Medicaid and Medicare programs and things like that. Very cheap stock, by the way. Talked about this one before, but for anybody who's watching now who didn't hear me comment about it, I might as well just bring it up because it was looking at the term structure that got me digging into this to say, okay, well, what could be coming up? So it's just an options trader saying, what's going on with options prices that makes me think something could be coming down the pike? What that something is that they lost a significant portion of their contract in Texas, their Medicaid contract. I think it was like 66% of the contract size they had that got paired. And now some people are wondering whether Florida and Georgia might cut their contracts as well. And they're thinking that Florida is going to announce on the 25th of March. So that's next week. So, there's no earnings, but there is a potential catalyst. And I can tell you that if a big government contractor in this space starts losing state contracts, that's material, and that might help explain why this stock is trading at less than 13 times earnings. I don't necessarily have a view on this one way or the other, but if you have a position in it, it's something to think about. Okay, so before I start taking some questions, which I most definitely want to do, I just wanted to talk a little bit about the fact that options prices dropped pretty significantly intraday today after we got the news from the Fed. So this actually sort of goes, and I'm going to look at the VIX index. So the VIX index, the nice thing about the VIX index is that it's very, you can see it published everywhere. You don't have to go look at fancy term structures and try to figure out what's going on with SPX options, which is where these prices come from. And what we can see is that the options market was clearly waiting until they heard from the Fed. This was the VIX index level throughout the day. 2 o'clock, bang. They come out, we're going to give you 3 rate cuts by the end of the year, most likely. Fed always gives themselves a little bit of Fed speak wiggle room in all of this. But the market viewed that very positively. That took a big unknown off because, as I previously indicated, it was only recently that the rate markets began to forecast that there might not be 3 rate cuts this year. And now they came back and say, no, but that what you see in the dot plot is probably the case. So what that has done is it has lowered the cost of hedging one's portfolio. Now, there are a number of ways that one can hedge a portfolio. The most obvious of those is simply to buy puts. You could buy puts on the stocks that you hold. That is a very expensive way to do it and generally isn't all that cost effective. Let's sort of take a quick peek at how that plays out in the real world. So we have an example. If I look at SPY, for example, and I think this is a good example because most people have some correlation to the S&P 500. If I go out and take a look at some SPY options that expire, let's just go out to the end of, I'm going to go to the end of April. Reason I'm going to the end of April for this exercise, I'm just going to switch these over to puts, get rid of this one for the time being. And we'll go down to, let's just call it 30 delta put. You can see the deltas over here on the right side of this little thing that I'm using. I'm sure whatever system you use is doing something similar. So 30 delta put is the 513 strike option. And the 513 strike option is pretty tight to where we ended up closing, 520.5. So that's down less than 1.5% from the current level of the SPY. And the mid-market premium for that's $3.93 a share, $393, 100 shares contract, all that jazz. So what you're paying is 76 basis points. So less than 1% to own an option that is less than 1.5% away from where the market is right now as downside protection. Now you'll notice that on a scoring basis, this doesn't score that highly. Couple of reasons for that. One of them is, and I think this is an important point, betting that the market's going to fall as a sort of a recurring strategy is a really dumb thing to do. And that's because the markets over time will generally rise. However, when the market is at all-time highs and these premiums are low, and you still think that there could be more bad news to drop, well, then this actually seems like a very reasonable price to me. Using a put spread would reduce the cost still further. What are some of those other shoes that could potentially drop? Well, Chairman Powell gave some clues to that. Interesting comments, because he was sort of talking out of both sides of his mouth. I'm not trying to knock the guy. This is just how the Fed is. He did say 3 cuts and said it was most likely going to happen that way. And that they were not going to have to get down to 2%, their target inflation rate, to do that. So I think that's kind of important, that basically if the path to their target inflation rate appears to be fairly clear, then he basically signaled that they could potentially cut rates even before they get there. I'm not sure that's a great idea, but the market loves that kind of thing. Did indicate that other reasons why they would be cutting rates would be employment, if that comes in weaker than expected, or if they get other weak economic signs. Well, the question that a listener might ask themselves is, okay, well, why would he make a comment like that? Why would you say, we're trying to cue you up for the idea that we're going to cut rates even though we haven't hit our inflation target? And some of the things that would motivate us to do that include, weaker than expected employment data or weaker than expected economic data. And my guess is because they're trying to front run that possibility. So if it is because of weak economic data, then you might want to consider a hedge like this one, because they are quite cheap. End of April, will capture the next Fed announcements as well, which is, one of those things that and also the inflation data, which comes out at the end of the month. So those are things that I like to look at. So let's take some questions here. Okay. CMC reports earnings tomorrow. Today, the company announced raising of quarterly dividend from 16 cents to 18 cents. I took this as a positive and bought the May 55.62.5 call spread. Good or bad? Thanks. Okay, well, why don't we take a look at this one and see what we think. Okay, so a quick important point about dividends and calls, and that is that all else equal, as dividends rise, call options that capture the period of those dividends, so are on the long side of the future ex-dividend dates, that will capture that new higher price dividend, the value of those calls, all else equal, should fall. As rates go up, the value of calls goes up. As dividends go up, the value of calls goes down. And the reason is that it is a cost to carry issue. If you own the calls, you don't get the dividends. But higher dividends, all else equal, could also promote a stock price. People like higher dividends. I can tell you for sure that when companies are expected to report dividend increases and don't, or worse, lower them, that's almost never considered to be a positive. It might be good for their balance sheet, but it's not viewed to be a positive for the stock. So, and you can often see this in stock prices, by the way, because what you will see is that when dividend rates are exceptionally high, that's not a good reason to buy the stock, because people are forecasting the dividend's going to go down. Okay, anyway, so the May 55.62.5, hey, voila, that's actually the default in here. So you're paying $2.77. This one's actually slightly in the money. It's actually in the money by $1. So the extrinsic premium on this is just $1.77. So that's not bad. I rather like the strike selection that you have here. So we can see that that's basically right at 1 standard deviation to the upside. So that's an attractive element. And one final point, their next dividends, when are they going next dividend? Let's have a quick peek here. So better yet, you get the benefit of enthusiasm that comes from higher dividends, but you're actually not going to pay the price. And why? Because the next ex-dividend date for CMC is going to be on June 28th. And so May doesn't capture that. So as a directional play, I like it. All right. So let's see. What do we got next here? How to hedge NVIDIA for 30 to 45 days. How would you calculate the deltas? Oh, how to hedge 400. I'm assuming, okay. I'm assuming you mean 400 shares of NVIDIA for 30 to 45 days. Okay. So let's go through that. And by the way, I can well and fully appreciate why folks might be interested in hedging NVIDIA and actually some of the other AI type names. You know, we owned, we had Marvell, we had Broadcom going into earnings, a couple others. I really don't think, and NVIDIA too actually, really don't think that these stocks have behaved all that well lately. So these were the market leadership all of last year basically, and the beginning of this year. But since we've seen earnings from several of these, they just haven't been able to sort of regain that prior mojo. So taking a look at hedging approaches that one might use. The thing is that the options on these tend to be pretty expensive. And I'm not enamored of spending big premiums to do that. One thing you could do is give yourself a partial hedge using something like a put spread collar. And a put spread collar, basically you're selling an upside call and you're using the proceeds to help finance the purchase of a protective put spread, partially protective put spread to the downside. And why don't we just take a look at what something like that might look like. So I'm actually just going to put bearish in here. That's not because I'm making a bearish trade or anything, but I'm just going to use that because I know it's going to load up and I'm just going to let it go to the default expiration. So $900 share price. If you're buying protection against a long, don't buy it in the money because essentially you're just taking your money off the table already. So, you know, consider getting something a little bit out of the money, maybe 875. Where's that lower one here? Okay, so you can see just how expensive this is. $40 to buy that put spread. And, you know, you're dealing with something that's nearly, it's not quite, but we'll call it 5% of the stock price. And, you know, that's gonna sting. You're doing this 4 times, so you can see that the cost of this is going to be over $4,000, and you would be doing that 4 times, so you're going to be paying about $16,500 to put that trade on. So what you could do is then look to a higher strike call to potentially sell to help finance it. This actually makes it pretty easy because we know how much money we have to offset. So we can just look for a premium that seems reasonably attractive and, you know, look to sell something like that. And I can go up even a little higher. Let's see, how about this? Is that about scratch? Even higher. Nice round number. All right, how's that? And now I'm just going to add stock to this thing. All right. So this is essentially what your position is now going to look like. I want to get this thing to a level where it's about, yeah, so like this. Okay, what do we got? Let's take a look at how that position behaves now. Well, you still get upside in this case from, you know, $900 to the short strike that I selected in this case, which is $990. So that's 10% upside, and then you're giving yourself some downside protection. Not immediately, because I had it kick in at around $875 here. but I'm giving myself $90 worth of upside, and below 875, 25 bucks in a stock like this, I mean, it could move that much very quickly. It'll move $10 today, right? So $25 isn't a huge swing for a stock that's almost $1,000. But you can soften that downside blow materially in the event that the stock pulls back. So that's a way to do that. Let's see what else we got here. So could you go over the details and strategy and how the break-evens were calculated of the FedEx calendar put that you covered on options action? Okay, so I'm assuming you're referring to, I think it was actually on Fast Money, and they called it an old school options action hit. It was framed up by something that Carter said. And I believe, and I actually, well, no, we have positions on in FedEx, and so it was probably mirrored close to something that we have on, but I closed that trading system, so I don't actually see exactly what we have. I'm imagining that it was something similar to what I was describing before, where I'm looking to capitalize on the fact that FedEx is going to have this move. So like I said, they're going to be reporting tomorrow. That's the 21st. So this is a situation where oftentimes I like to go out. I'll just use July. Probably the 250 put spread would have been the one that I'd have chosen. People who watched, you can go ahead and put it into the comment section here. But the 250 put calendar is very likely the one that I would have traded. What do we have here? So this is basically fading a little bit bearish. Now, I should preface this by saying that I have a little bit of a history with this stock, and it's not all great. So on multiple occasions, late 2022, we were long the stock, had its worst earnings result post, after they reported earnings. The price action thereafter was the worst it had been in 40 years. So that means that we were long the stock right before it had its worst earnings performance since way before I even got into the business, since way before I graduated from high school, actually. So that was just a ridiculous situation. And so that gave me a bad taste. But actually back in 2010, 2011, I got punched in the face. In this one, it was a horrible six-figure day, FedEx. So, sometimes stocks don't agree with us. This is a stock that just doesn't agree with me. So you'll notice that when I chose this calendar spread, that it sort of shades it to the downside, which probably means the stock's going to go up. But you can see that the peak profits happen when you get into a put spread. There's a sort of a saying that options traders use. You want stocks to run through your long strikes and to your short strikes to maximize your profits. It's not always going to work out exactly that way. And, if you're hedging your deltas with stock, it's not necessarily going to apply that way. But it's a rule of thumb. So when you put on a straight calendar and you're long a longer dated option and then short the same strike of a near expiration, your target is that the stock goes right to that short strike. And the reason is because that's the level at which the extrinsic value of any option is maximized that has not yet expired. But it is also the level at which an expiring option is not going to have any value. So you're going to maximize the extrinsic value of the option that you own and minimize the intrinsic value of the one that you're short. So 250 is where you're going to see peak profits. Now, quick point about this. When people illustrate these kinds of trades, oftentimes they don't account for the fact that when an event happens, all options premiums that capture that event will typically decline thereafter. So that would include the July options that we're owning in this calendar spread example, but that captures two events, including the subsequent earnings. So that vol crush, that sort of Vega hit that you're going to take. Vega, if you don't know, is the change in the value of an option for a rise or decline in implied volatility, which is something we seem to be talking a lot about today. That was not my intent, but because of some of these other factors, it just sort of became today's topic. So that's the whole objective. And you want it to run to the short strike. You'll see profits. In this case, the upside estimated break even is 272, and the downside break even is 233. And those break evens, by the way, are for Friday. So we're talking about the day after tomorrow. I like those kinds of trades when the implied move going into earnings is very, very high. Okay, here's another one. Why not a double calendar? Okay, double calendar. I mean, for people who aren't familiar with these sort of conventional calendar spreads, I'm assuming he might be referring to something like a strangle swap. And now we're combining a whole bunch of stuff. Strangles, swaps, calendars, what is all this fancy stuff? It's really not all that fancy. What we're really just talking about is a situation where, I might trade a calendar put spread and a calendar call spread the same way. So let's just go ahead. Oh, actually, yeah, these were supposed to be puts, but I put in calls. It doesn't actually matter, as you'll soon see. So now I've got the 270s in here, so I can just make one of these the Julys, buying that, selling that, boom. What do we get? We get a trade that looks a little bit like this. And what ends up happening is those break evens actually stretch out even further. And here, this is a little bit peaky. Notice what happens if I adjust these strikes further away from where we are right now. So I go down to the 220s, for example, on the put side, and I roll up to, call it the 280s or 290s. I'll just use the 280s for this example. Oops, went too far. I guess I have to stick with the 230s. You can do this, and you get this kind of a shape. So remember what I said, peak profits for a calendar spread are going to be at the short strike. Now I've got two of them, so I spread them out, and now I have this situation where I'm not going to see any money at spot, but maybe that makes sense. You think, oh, well, the stock could go up or it could go down. And so you can manipulate the strikes until you get the shape that you like. But actually, one of the reasons I don't do that on CNBC is it's just too complex. We've already been talking for an hour, and these kinds of explanations aren't suitable for a 2-minute recommendation. So what else we got? Okay, what parameters do you use for a call spread risk reversal? The implied move. So actually he's asking two questions here. DTE, days to expiration, so how far out in time, and the other is deltas. So you could use deltas to choose your strikes. The way I like to think about it is I like to think about the implied move up and the implied move down. Sort of that's basically the predicted range that I think we're going to live in. You could think about it as one standard deviation up and one standard deviation down. So if I'm using a call spread risk reversal, buy the at-the-money call, sell the implied move up, and then sell the put that is the implied move down. What is the implied move? Well, for a back-of-the-napkin technique, if you are doing more sophisticated things and you have a really sophisticated price-weighted probability distribution, the implied move up and down may not be symmetrical, and in fact, they are not. But does that really matter for most traders in this kind of context if you're not trading volatility? Actually, no, not really. Take a look at the value of the straddle and use that as your implied move up and down, and that'll just give you a framework. With respect to the time to expiration, if you're using it to hedge an event, then obviously you want to make sure that you capture the long side of the event. And by the way, this is a good time to use them because usually events are circumstances where options premiums are elevated in the first place, which is why buying one option and selling two can make a lot of sense. Bear in mind that you will get cases, though, where those options prices, however big the implied move is, isn't big enough. We talked earlier about Foot Locker earnings, which came out and absolutely were disastrous. The implied move was just under 17%, and the stock fell over 30 right after they announced. So implied as a guideline, not an actual rule, as Captain Barbosa said in Pirates of the Caribbean, I think it was. Okay. What's a good play on Micron out of tonight's earnings? Well, you know, one of the tricky bits that one has to contend with, let's see, where is the stock actually trading right now? Of course, one of the systems that has, well, I should probably boot up one of the others. The difficult thing here is that when it comes to trading options, we often do need to wait and see. Two reasons to wait and see, actually. The first is that I don't necessarily take the first knee-jerk reaction that a stock makes after hours following an earnings result as the gospel. Oftentimes, it takes a little bit of time for things to sort themselves out. First of all, real money accounts, and when I'm talking about real money accounts, I'm just talking about the big mutual fund companies. Anybody who has a substantial position, it can take days to weeks to move, or even sometimes longer than that, to get into or out of big positions. Oftentimes, they will see this information, they're going to digest it, then they're going to start to act, and you will start to see that play out over the course of a couple of days in the subsequent price action. But the other principal reason is we can't trade options after hours. So if I remember, I'm going to try to address that tomorrow. Okay. Well, let's see. I'm going to take one more because I've kept you guys way too long already, and I apologize for that. Nike. I have a Nike short strangle, 115 call, 90 put, 30 days to expiration, collected 224 at entry. How would you calculate the P&L for it if it drops 290 after earnings? Would you use a simulator? Okay. Well, you can use a simulator, and if you have one, of course, by all means. Well, let's just take a look at a couple things here with that. So Nike closed today around 100. You've got 30 days to go, which would be, you know what I should probably do is I should use, I think this illustrates this fairly nicely. So short strangle, let's just put that in. Yeah, I'm gonna over here, but I have to get this trade in. We'll go over here. 30 days to, there we are, 30 days to expiration. You're short the strangle. You are short the 115 call. Oops. And the 90 put. Earnings. Okay. You were asking about earnings as well. Okay, so the company they're reporting tomorrow. And actually, I should know that because I had been trading it, but then we bailed on the Nike position. So what you can do, yes, you can, this is something you can do, is you can put in the price. This is in here. You can use a simulator, and we will. So I'm actually just going to go, for the sake of argument, to the end of this week. All right. Implied volatility. So this is kind of the magic bullet that this is the thing that is important. So we've talked about this a lot. Implied volatility will fall after the company reports earnings. And so, you know, where art meets science is your forecast for what that volatility might look like. So if you take a look at the history, it appears that after the company, at least the last 3-4 times they've reported earnings, the implied volatility has fallen down to, I mean, it's actually in some cases the low 20s. We don't have to be quite as aggressive as that, but it's going to drop. And it's going to drop. It's going to drop a lot. So, you know, this gives you some sense, right? So if we take a look at what's going on here, you can see what those prices look like. Now, if you were short one that expires on Friday, and if it gaps down to 90, so that's the funny thing, right? So that's the, this thing could move 10% to the downside, and if you happen to have been short the 90 115 strangle that expired on Friday, there's nothing in it, by the way. It's not a juicy strangle to be short, not recommending it. But if it ran right to that short strike, remember what I said before? You want it to run to your short strikes, essentially, and not through them. If you own it, you want it to run through that strike. If you short it, you want it to run to it. If you were short that strangle, that basically means that you picked your strikes perfectly and you still ran home with all the money. But yeah, you could use a simulator like this. I'm sure a lot of the applications you guys have will help you do something like that. But an important point is that you want to suck some of that premium out of your forward estimate after the earnings event takes place, because you know that's what's going to happen. That's when you get that vol crush, and that is going to reduce the value of those options considerably. And in fact, this is where a lot of people who are first starting out and saying, oh, I'm going to try to play events, so I'm going to buy some call options, and if the stock goes up, I'm going to make many times my money. The stock goes up, and they look at their call option, and maybe it's up a little, or maybe it's down a little, or maybe it's unchanged, and they're saying, what gives? The stock went in my chosen direction, but the call option didn't. And usually the culprit is implied vol. So on that criminal note, we're going to wrap this one up. Please like, subscribe, leave your comments, leave your questions, leave your suggestions. If you're going to say that I talk too much, too long, I know, I'm working on it. But for those of you who hung around to listen to all of that, I really appreciate it, and I'll see you next time, Monday, 4:15. Thanks for watching.